Hey, Jason here. Today's video I'm going to answer the question, should you invest in Guardant Health, stock ticker GH? This is an investment analysis for KBL who requested this on YouTube. Before I get to that though, I need to let you know you can get this podcast or video as a podcast anywhere in the world for free on all major podcasting platforms, Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You get this as part of the I Love Value Investing podcast anywhere in the world for free. And if you like this video and other videos, make sure to check out or make sure to subscribe and hit the notification bell here on YouTube so you're notified anytime releasing a video and releasing videos all the time. Okay. I apologize for this. I don't want to do this, but I have to put this little disclaimer on here because every time I don't, I get nasty comments. So, I do not short sell ever, so I don't benefit from any stock I talk negatively about. I also don't own any stock in a long position of a stock I talk positively about. These are for informational purposes only to help you figure out how to spot potential red flags and spot potential great stocks faster using my processes that I've built in my analysis that I'm going to show you in this video that I've built up over the last 15 years. Because these are viewer requested videos, I also don't know about the company's story. Frankly, I don't care about the company's story. I don't care what the CEO says that they're going to do. I don't care about the plans. I don't care about any of that at this stage of the analysis. That comes far later in my analysis structure. So if a company doesn't meet my initial margin of safety requirements here in terms of its profitability metrics and stuff like that we're going to get to, I discard the company. Why do I do this? To discard companies I don't want to invest in faster so I can spend more time researching companies I do want to invest in. Why should you listen to anything I have to say? In the first 9 years of my career, I've produced average annual returns for the portfolios I manage of 23.5% per year on average. This puts me just behind the great Warren Buffett, who produced 24.2% average annual returns in the portfolios he managed in his Warren Buffett Limited partnership back in the, 60s. And these numbers legitimately make me one of the best stock pickers in the entire world over the last 9 years. I'm not saying that to brag. I'm saying that to prove to you that hopefully I know what I'm talking about a little bit. So, having said all that, let's get to the analysis now. Again, I apologize for that. I don't want to do that. I have to do it. Okay, so we're doing Guardant Health today for KBL. Thanks for this recommendation. I have not researched this company before. This is a sign right here. The company's unprofitable. This is a sign right here with price to sales, or the forward PE, sorry, for those of you watching on the podcast, is being unreadable here. This is a sign the company is unprofitable because it's not coming up, and price to sales being 41 is a sign the company is massively overvalued. I don't care about price to sales ever, but anything above at this level is a sign the company is massively overvalued. Okay, Guardant Health is based in blah, 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 blah. It provides cancer blood test and analytics for clinical and research use, and the firm maintains research partnerships with large biopharmaceutical companies. Company offers Guardant Health 360, a blood-based liquid biopsy test for treatment, selection, and advanced stage cancer, and Guardant Omni, a broader gene panel for immunology research. Company's pipeline includes Lunar 1 for cancer recurrence detection in survivors, and Lunar 2, a liquid biopsy for early detection of cancer in higher risk individuals with an initial focus on colorectal cancer. Additionally, Guardant offers research development services. Okay, so they're a health company. They're a testing company for cancer, it looks like. Nothing of major note in there. If you haven't seen my recent videos, I've been reading those lately, not only to learn a little bit about the company, but because you can spot potential competitive advantages in here as well. Not anything of note in there today, though. Okay, its revenue skyrocketed from $25 million in 2016 to $298 million in trailing 12-month period. It's fantastic, of course. The operating margin is not fantastic. Operating margin on average over the last 5 years has been around negative probably 100%, meaning for every $1 they earn in revenue, they're losing $2 in operating profit. My guess is, based on experience, that they are putting a ton of money into R&D, and that is lowering profits by a crazy amount. Shares have gone up. That's one way they're staying alive, is they're issuing shares to raise cash. Book value per share is all over the place. It's negative $2.85 in 2018. Now it's $8.38 a share positive. I don't know why that happened, because they're massively unprofitable in this time on an operating cash flow on an operating income basis and on a free cash flow basis as well. So my guess is there was some kind of acquisition in here that increased goodwill, that increased the book value per share. We'll get to that when we talk about the balance sheet, though. ROIC is massively negative over the last 4 years, including the last 12 months, the trailing 12-month period. It's an average of probably negative 25-30%. I look for anything above 10% on a consistent basis, so again, not good. Free cash flow to sales. Whoa, that is really bad. I look for anything above positive 5% on a consistent basis. Over the last 5 or so years, it's been negative probably 100%. Again, so it's probably similar to the operating profit. Meaning for every dollar in revenue that they generate, they're losing $2. So they're spending $1 to lose $2, essentially, is what this shows. That's not good. A ton of cash. My guess is from the share issuances, probably also issuing debt. Intangibles do not make up a huge portion of their balance sheet, so maybe there wasn't an acquisition, which makes me even more curious as why their book value's gone up, which is answered here. They have issued a ton of debt. The balance sheet is 48% in debt, long-term debt now. Before 2020, that was at 0%. So they likely issued a lot of debt because of the COVID lockdown and uncertainty, and that is a large increase from their balance sheet, because debt, when you issue it, turns into cash, which turns into an asset on the balance sheet, which increases the book value per share. Okay. Cash conversion cycle has gone up by a huge amount. That's not good. That means the company's becoming less efficient over time. Why has it gone up? Because it's taking longer to sell stuff, about 8 days longer to sell stuff. It's taking about 2 times longer, from 45 days in 2016 to 98 days in the trailing 12-month period, rounded up, in their inventory to sell their inventory, or that's how much inventory they have, sorry. And their payables period has also gone up by about 32 days, which without that, their cash conversion cycle would have tripled or quadrupled. All of this shows me, and I'm only going to do it briefly here. I've covered cash conversion cycle in more depth in other videos. I'm not going to cover that in depth here, what all these individual numbers mean. But what this means, it's taking longer to sell stuff, which is leading to higher inventory rates, which is leading them to paying longer for their supplies, whatever they're selling, again, their test kits, whatever they're getting from their suppliers. What this could mean, or a couple things this could mean, is because it's taking longer to sell stuff. Or here's a couple things this does mean. This means they're becoming less efficient over time. This means they're taking longer by about almost 30 days, 28 days, to turn their inventory into cash, or cash into sales, or their inventory into sales, their sales into cash, and their cash into more inventory. When this happens, the company has less cash flow in the business, and most reason companies die is because they have cash flow issues. It's not because they have too much debt. It's because they have cash flow issues. The inventory specifically means, it's gone up about 2 times, that maybe their products aren't selling as good as they thought and they bought too much inventory. Maybe they bought enough inventory and their sales have slowed down, which is indicated up here that it has to some degree. None of those are good. If inventory continues to rise, it could mean the company has to mark down its products, which means lower revenue and lower profitability. And as a company that's already unprofitable, that is a bad thing. Okay. Negative 58.5 here on the interest coverage ratio is, again, another bad thing. It means the interest coverage ratio measures how much or if a company can pay its current interest on its debt with current operating profits. Because it's unprofitable on an operating profit basis, it cannot do that. Anything above +1 is considered good. The higher the better, because it means the more cash or the more operating profits you're producing compared to your debt levels. At negative 58, that is, again, not bad, or not good. Sorry. Debt to equity ratio is high as well. I look for anything below 1. Depends on how profitable the company is, the industry the company is in, the business model, all that stuff. But generally under 1 is considered good. But again, the company is unprofitable, so it having a lot of debt is not a good thing. Okay, you can see the huge spike here in debt levels from Q3 2020, Q4 2020. So they issued a ton of debt. They issued about $800 million in debt in Q4 2020, and they issued another $500 million in Q1 2021. Why? Well, I'll get to the actual reason why here in a minute, but likely because they are having issues, they're unprofitable, and they need the cash to continue to sustain the business. Frankly, if that is the case, and I guess that would be the case, that is unsustainable, because essentially what the company is doing here is issuing debt to fund operations and growth. For now, the money sits in cash, so it looks good on the balance sheet, increases the book value per share, but it's not really realistic because it's coming from debt issuances and share issuances. It's not coming from the operations of the business. When this happens, the company is essentially issuing debt to fund the operations, and it continues getting further and further and further into debt unless it can become profitable and do those kind of things. Most companies do not end up doing that. Sorry, my train of thought got cut off because they have a ton of short-term investments. They have $1.94 billion in cash equivalents, and short-term investments, and most of that is short-term investments. Not surprising, it's just interesting more than anything, because again, so what they're doing here, short-term investments are typically, I think the terminology is less than 6 months, less than 90 days, one of the two. So it's typically like a short-term debt instrument, like a 3-month bond, something like that. They're trying to earn some kind of return on this while they hold the cash, so it doesn't just sit in a bank account and lose money like it does for the rest of us. Companies have the same problem, so that's interesting more than anything. Okay. Another thing interesting of note is their assets. About 85-ish percent, 90% of their assets are cash equivalents or short-term investments. Normally that's a good thing, because it means the company has a huge margin of safety and is producing a ton of cash from its operations, blah, 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 that good stuff. In this case, again, it's not necessarily a good thing because it's companies issuing debt and issuing shares because it's massively unprofitable, which gives it a ton of cash until it spends it or burns through it. Or that makes things look better than they really are. So their debt levels, their liabilities are actually good other than their long-term debt levels. They have a clean balance sheet other than their debt levels, which is a massive issue for this company. Okay, let's go to the cash flow statement. Okay. So they purchased something. So they issued debt to purchase something, it looks like. But there wasn't a lot of goodwill, so that's a bit confusing. I'll get to why in a second. Okay. So, again, the process I'm showing you here is the exact process I would go through for any stock. I'm looking at Guardant Health acquisition. That was in 2019. This looks like it happened in 2020, though. I'm not seeing anything. Oh, debt issuance. Okay, so let's go see what the company issued the debt for. It probably says general corporate purposes or something along those lines. What's the interest rate? %, bond. That's interesting. Very interesting. Most companies that are unprofitable can't issue debt at 0%. Frankly, most companies on earth can't issue debt for 0%, even if they are massively profitable. So that is very interesting. So in exchange for the low interest rate, or in this case, 0 interest rate, these are convertible bonds. Meaning, at some point, this could cause massive share dilution, because one bond is worth, I don't know, $1,000 worth of bonds is worth 7.15 shares, which represents an initial conversion price of $139.82 a share. What is the current share price? So the current share price is 125.48. So right now the bonds would lose money as soon as they're issued. But the plan is whoever gave Guardant the loan, I'm not seeing it, is hoping that with this 0% interest rate and Guardant's continued improvement, that these shares will be worth far more than $139. Let's say the shares go up to $200. If they convert at 139 and change, whoever loaned them this money is banking that that's going to happen. First of all, if that happens, that company is going to make a ton of money. Instead of interest rates, in interest, it's going to own equity in the company. And it's going to make that difference between the 139 and let's say $200 a share as well. So it's going to make money in multiple ways, and that's its hope. I'm still surprised with it being massively unprofitable that it got a 0% interest rate. Good for them though. Okay, so right now, Guardant Health does not look like a good investment for me and the portfolios I manage, because it's massively unprofitable, issuing a ton of debt to sustain operations. Even though the debt terms are favorable, it would lead to share dilution at some point if they are issued, which I can show maybe here on the income statement, which I frankly never show you because I never use it. So that is not showing here. So because I think these are things like options, warrants, stuff like that. It doesn't include convertible bonds, I don't think, this calculation. But for every $1,000 in this loan, that's equal to 7 shares. So $1 billion. So that's equal to, let's see here, 1 billion divided by, so that's 1 million new shares. So that's, I mean, it's not a huge amount of dilution. They have 101 million shares. Actually, it does show the dilution right here, most likely. Up from 100 and, where are we at here? Timeline. Okay, yeah. So this does share the dilution, just is less than I expected it to be. So it's not a huge amount of dilution, but it's still something to be concerned about, because frankly, they're burning through a ton of cash and they might have to do something like this again. and next time the terms probably won't be as favorable. So right now, not a company I research further, and that will be confirmed here. Oops. By looking at the valuation, which it's going to be absurdly overvalued, which I can't show you here because it's unprofitable on a net income, cash flow, and operating income basis. So again, if you haven't seen my other videos, this is how I illustrate the overvaluation. So let's find a similar size company. Oops, what happened? Okay, so this is a $12 billion company. Okay, let's go with CHRW. I'm a little bit familiar with that company. Oops, not what I wanted to do. Okay, so these companies have similar market caps, which is supposed to be the value on the stock market. That's the price, though, and the price and value are two different things when it comes to stocks. So what I'm going to do here is illustrate this massive difference. With, not that yet. Okay, so these companies are about the same size in terms of market cap. CHRW has $17.2 billion in revenue. Guardant Health has $298 million in revenue. CHRW earned $787 million in operating profit in the positive. Guardant Health is negative $328 million. So that's a difference about more than $1 billion. Cash flow, positive $331 million for CHRW. Negative $143 million for Guardant Health. Why am I showing you these things? Because over the long term, companies are valued on their profits and the cash flows they produce. And to illustrate that, CHRW, I would say, is slightly overvalued right now. EV to EBIT is 18.03. I like for anything below 8 to show a company undervalued or a company as undervalued. I don't care much for PE, price to cash flow, and forward PE, but when I do, I want them to be under 20. This is at 21.6, 34 rounded up, and 19.2 respectively. So CHRW is overvalued by a decent amount right now, and it's far more profitable, produces far more revenue, produces far more cash flow than Guardant Health, which means Guardant Health is enormously overvalued right now. Yeah, no, there's no way I would invest in this company right now in the portfolios I manage for this reason and the other reasons that I talked about, frankly. For me and what I look for in investment, not really any redeeming factors, frankly. In terms of the story, yes, blood testing, genetic testing, all that stuff is going to continue. But again, I don't care about the story at all right now. The numbers are pretty bad, frankly, for Guardant Health, and there's no way I could invest in it in portfolios I manage. So thank you. What we got here? KBL for recommending this. Love to hear your thoughts on this analysis. From anybody, if I miss anything, if I didn't explain something well enough, if I should have explained something better, let me know in the comments below. If you're watching on YouTube, make sure to like, love, share, subscribe, all that good stuff, and hit the subscribe and notification buttons or bell so you're notified every time I'm releasing a video, and I release new videos all the time. If you're listening on the podcast, we'd really appreciate all that stuff as well on the podcast. We'd also really appreciate a review, because the more reviews, views, and listens we get on our content, the more people we can help. If you're looking for more specific help on how to become a better investor faster, you can check out our free gifts below this, including our 5 free gifts, which includes the full written worksheet that you just went over, so you can analyze stocks like this by yourself better, faster, more efficiently. You can get that as 5 free gifts below. You can also get our my free copy of my book, How to Value Invest, and a free copy of our guide, 7 Tips to Picking Great Stocks in 3 Times You Must Sell. You can get all 3 of those for free at the links below. And if you're looking for more specific help from me, on how to become a better investor faster, make sure to check out the link below for our newly relaunched masterclass, which I'm super excited about. Would love to have you in there, and you can check out more information on that below as well. But until next time, have a great day. Talk soon. Bye.